Good afternoon and welcome to the final installment of the First Citizens Asset Management Limited 6-Step to Financial Freedom Program. Again, I am Nadira Sipasad, the Senior Marketing Officer at First Citizens Asset Management Limited, and I will be your facilitator for today's webinar. The aim of this 6-session program was to build investor confidence through a series of financial literacy webinars which encompassed both savings as well as investments. The program was not designed to sell the products of First Citizens, but rather it was created to educate and inform the public of the need to take control of their own finances. First Citizens Asset Management Limited started its financial literacy drive in 2005 through hosting a series of seminars in Trinidad and Tobago, and the program has now grown to include personal meetings with corporations and now the newest edition, financial webinars. Just to recap the previous sessions, Session 1 focused on the fundamentals of savings and investments. Session 2 gave a better understanding of risk. The third webinar gave financial tips on financial planning by life stages. The fourth webinar consisted of credit management, the fifth, understanding your investments, and the final installment, which is today, shall be an overview of all of those topics. Today's webinar will be 30 minutes in length with 25 minutes presentation time and 5 minutes to answer any questions submitted. If you would like to submit a question, please type it into the question window in your control panel. This can be seen to the right of the viewing window. If you do not see your control panel, please click on the red arrow to expand. Questions will be addressed at the end of the session. 2 polls will be conducted during this webinar. Please keep your viewing panel open after selecting your poll choice. I would also like to advise that all attendees will be in listen-only mode for the duration of today's webinar in order to ensure a smooth flow as time is limited. This webinar is for informational purposes only. The investments mentioned may not be suitable for all investors. Please be advised that all investments do involve some degree of risk. When making any decision, you need to take your own financial situation and risk tolerance into consideration. Before making any investment, you are advised to read a prospectus. Today's webinar will give you a brief overview of savings and investments, the risks attached to savings and investments, financial planning by life stages, credit management, understanding your investments. As I said, today's webinar will give a brief overview. If you need further information on any of these topics, you can request a copy of the presentations used in the previous webinars, and within 1 week's time we'll also have the previous webinars available online for your own viewing and listening pleasure. Savings versus investment. For those who were with me from the first session, we covered that saving is your income not spent on consumption. The income that you have not used on your consumables, on your bill payments, the amount of funds that is left in your account after you have paid your bills, made all your necessary purchases, and that you have no intentions of touching again for consumption is savings. Investment, on the other hand, is the purchase of a financial product or item of value with the expectation of favorable returns. Basically, it is using your money to make more money for you. So savings is basically where you're putting aside money. Investments is where you're using money to make more money for you. Why save? We save as a measure of precaution. We save to accumulate capital, and we save in order to meet short-term needs. You need to have savings as a measure of precaution. What I normally advise is that from the moment you get paid, you put aside a portion of your salary for any unseen events that may occur during the month. For example, an unseen doctor's visit, an unseen maintenance to the vehicle, something that you cannot predict. You put aside something for it. So you save as a measure of precaution. You save in order to accumulate capital. If it is you have plans and you need capital, such as a down payment for a vehicle, down payment for a home or something, you will have a savings plan in order to meet that need. You also save to meet your short-term needs. If it is you'd like to you have a wedding to go to in the next month, if it is you have a graduation coming up, you also save for these, which is very different for investments, because everything I just mentioned, an investment product may not work well because you need access to these funds in a short period of time. Why invest? To provide a hedge against inflation, to better satisfy medium to long-term goals, namely retirement, for improved lifestyle, greater returns, for a sense of security, to provide a hedge against inflation. One of the major things that you will see right now is that inflation in the country is much higher than the rate of return on your deposit account. Right now, you're very lucky if you're getting as much as 0.7 on your savings account. You might be getting 0.5 on your regular savings account. Whereas if you think of what inflation is, if you take inflation into consideration on the real returns on your savings account, it's negative. Because whereas the funds, your savings is growing by 0.5%, inflation is eating at it with well over 5% at times. So you need to invest in order to provide a hedge against inflation to better satisfy medium to long-term goals, namely retirement. Again, this also ties to inflation, because if you think about the cost of living now as opposed to what the cost of living will be at retirement in 10, 20, 25 years, however it may be for you, think of what prices were like 10 years ago, 20 years ago as compared to what it is now. So in order to maintain value for your money, especially when planning to medium to long-term needs, and it's not just retirement, if you're planning towards the graduation or education funds for your kids, you're thinking at 18 years, 15 years, these are medium to long-term needs, and the cost of those things is going to increase, so you need to have an investment plan as opposed to a savings plan. In order, if you have just a savings plan, the amount that you need to put monthly will be a lot more as opposed to if you have an investment plan. For improved lifestyle, greater returns. If it is you have a lump sum of money, if it is you to have a choice, put it into a savings account, put it into an investment account, and you're not touching the capital, you get improved returns or greater returns if you choose an investment account. With your savings account, you get 0.5%, that's your annualized return, and you get a small amount every month. Whereas if you choose an investment product, that might be giving you over 2%, or depending on the product, you may get as much as 5%, and you get a higher monthly return. For a sense of security, when it is you have these plans in place, you're able to sleep better at night, not worrying what's going to happen when my kid graduates, what's going to happen if I get sick, what's going to happen when I retire and I have nothing to depend on because I have no pension plan with the company. So these are some of the reasons that you need to invest. Easy to implement savings tips. Consolidate your debts. Many of us have various loan facilities with different institutions at different rates, and sometimes we have 4 loans totaling $2,500, $3,000, whereas if we were to go for one loan and bring all of these loans together and take one loan, one tied rate, and you can shop around for where you can consolidate your debt, you would find that instead of paying 4 loans totaling $3,000, you might now have one loan where you're paying $2,200. You can free up that much by consolidating your debts, giving you additional disposable income at the end of the month. You can assign multiple utilities to one provider where possible. Sometimes there are specials where you group it if it is you want to take your cable, telephone, and internet with one company. Pay off debts with higher interest rates first, namely credit card debt. Credit card debt is one of the highest interest-bearing credit facilities, 24% annually. So if it is you ever have extra cash, sometimes it may actually be better to use it towards paying off your credit card debt as opposed to putting it into a savings account or even an investment account. Because if you have $3,000 and you put it into an investment account as opposed to paying off your credit card, your investment account might be paying you just between 2 and 3%. Whereas on your credit card, which still has an outstanding balance, they're charging you 2% finance charge per month. That's 2% per month. So it's always better to pay off debts with higher interest rates first. Use your bank's ATM. There's actually a charge of $4 every transaction for every time you use another bank's ATM. And you might think it's just $4, but if you check how many times you use it a month, it might actually work up to sometimes $40, $50. Well, $40, $48 because it's $4. More savings tip. for every pay increase, pay an additional 15% to deferred annuity plan. Why it is I choose a deferred annuity plan here is for two reasons. If you get a pay increase, your taxes are going to be increasing as well, provided that you're over the $5,000 per month bracket. If it is your PAYE is increasing, any contributions towards approved deferred annuity plan will also reduce your PAYE. For every $100 contributed, you reduce your PAYE by $25. The second reason for increasing the contributions to your deferred annuity plan is that when you have a pay increase, you suddenly see that you have an improved lifestyle. You want to maintain that improved lifestyle, which means that your original retirement portfolio may not be sufficient to maintain that improved lifestyle. So you now need a higher retirement portfolio, a larger retirement portfolio in order to maintain that lifestyle. So as your pay increases, your retirement portfolio should also be increasing. Turn a loan repayment into a savings deposit. Some of us have some loans where the monthly payment is as small as $300-400. If it is that you are managing just fine without this $300-400 at the end of the month, when you have repaid your loan in its entirety, you can now funnel those funds to an investment account or to a savings account. Pay yourself first. After paying your utility bills, your loan payments, we always advise that before you look to the expenses such as entertainment expenses and so on, you pay yourself first. So your payment into your own savings account or own investment account should come before expenses such as your gym fees, entertainment, movies, dinners, that sort of thing. Easy to implement investment tips. Again, for those of you who actually want further details on these, you can always request the previous webinar presentations. Easy to implement investment tips. Establish an emergency fund before seeking medium to long-term investments. Why I advise this is that if you do not have an emergency fund in place and you jump straight into medium or long-term investments, if the emergency does arise, you will now be required to break that medium or long-term investment, and there is normally a penalty attached to breaking a medium or long-term investment. So for my clients, before they get into any medium or long-term investment, I ensure that they have accumulated enough in their emergency fund because I do not wish to charge them for breaking their investments should an emergency arise. Diversify your investments, not only by institution but by product type. There are many persons who believe that diversifying their investments simply means having one fund with First Citizens, one with RBC, Royal Bank, one with Republic, and maybe one with Scotia and something in Unit Trust. However, if you have a fixed income fund in Unit Trust, a fixed income fund in First Citizens, a fixed income fund in RBC, you have just exposed yourself to the exact same risks in all three institutions because all of those three funds would be investing in the same types of securities, and chances are they are also investing in each other. Since with fixed income funds, they invest in fixed income instruments as well as other fixed income funds. So you need to diversify not only by institution but by product type. So you can have a fixed income fund with First Citizens, an income and growth fund with another bank, you can have a bond fund with another bank, so you need to diversify your investments. Don't be taken by labels. A lot of us see ads on newspaper, ads in the television. There's a special campaign out by a bank or an investment company. They're telling you special rates at a certain time, or they advertise a product for weddings, they advertise a product for a kid. And yes, these products are designed to cater to that market, but sometimes it may not necessarily be the product that is for you. So yes, there may be a wedding product, and although you may be engaged, another investment product may actually be better suited to your own needs. So even though we have the Abercrombie or the Paria as the Forever After in First Citizens, you may already have similar products and you may simply be looking for something else. So don't be taken by labels. Take advantage of investments that allow for compounding interest. Compounding interest simply means that you get interest on previous interest earned as well as the principal. This actually works very well for medium to long-term investments because with compounding interest, eventually the interest that you earned may exceed what you actually invested, because you continue to earn. For example, and one of the most popular examples is deferred annuity products. You contribute your monthly contribution of $100, $200, but when it is you have it for 25, 30 years, you realize that you may have contributed $150,000, but thanks to compounding interest, the interest that you earned might have been more than $150,000, so at the end of it you have over $300,000. So when it is you're looking for medium to long-term investments that have interest attached to it as opposed to dividends, you try to find something with compounding interest. Do not leave large sums of money in low interest-bearing savings accounts. Low interest-bearing savings accounts are a parking spot. It's not an investment, it's a parking spot until you figure out what type of investment it is you want to make. It does not make financial sense. Again, we spoke about inflation. If you have a large sum of money, $1 million, $2 million, it does not make sense to have it in a savings or checking account where it is earning less than 1%, where inflation is much higher, so that your overall returns are actually negative. A savings account and even low interest bearing mutual funds are parking spots for large sums of money until you have decided what sort of investment plan you're looking for. Be cautious of investments paying much higher returns than similar products on the market. For example, you find that there are similar products. Let me say a bond fund. There may be one bond fund at an institution saying, well, our last annualized return was 7%. Another institution might say our last annualized return was 17%. Both of them are bond funds. However, for the one offering 17%, you may need to ask them, how is it you were able to pay this rate when the other institutions are saying a rate that is much lower than yours? And then you find out what was the underlying assets, because sometimes there are different grades of bonds, and the institution with the lower interest rate actually has the bonds that are lower risk with a higher and better credit rating, whereas the one that was paying the 17%, it's a higher risk. So it's the same type of product, but the risk attached is very different because of the asset allocation, the actual types of assets and the actual bonds being held. So these are the things that I am telling you. When you walk into a bank, they tell you it's a bond fund and so on. They do not tell you what bonds are in this fund. You need to ask. It is all up to you at this point. Find out fees and charges attached to different investments. When it is you get into an investment, you need to ask what charges are there for withdrawals, what charges are there if you break it. You need to find out what fees there are, if the fees come out of the fund themselves or if the fee actually comes out of your account. Ensure investments are registered with the SEC for your own protection. The SEC has the CIS, the Collective Investment Scheme Guidelines, which are there to protect the investors. Therefore, the investments that are registered with the SEC must follow the SEC guidelines, which exist to protect you, the investor. Understanding risk. This is actually what we did in the second webinar. The main risks attached to deposit accounts. Capital preservation, because there is limited DIC coverage. DIC coverage is actually $75,000 for each depositor in respect of deposits held in each insured institution in the following rights and capacities: single accounts, joint accounts, and trust accounts. So that means you can actually maximize up to $225,000 in DIC coverage per institution that is registered with the DIC. You get $75,000 for individual accounts, $75,000 for joint accounts, $75,000 for trust accounts. Only deposits held in Trinidad and Tobago and payable in Trinidad and Tobago dollars are insured. Inflation risk is attached to your regular deposit accounts. As I said, and I've been saying it, your regular deposit accounts, your savings, your certificates of deposits, and your checking accounts have barely minimum returns. 0.5%, 0.7%, 0.75%. If you have $1 million and you want to put it in a certificate of deposit right now, you're very fortunate if you get 1.25%. So they have very low returns, which mean it has a great inflation risk because it is not providing you with a hedge against inflation. The risks most prevalent with investments. Liquidity risk. Liquidity risk is a risk that an individual or firm will have difficulty selling an asset without incurring a loss. That is, there may be a lack of interest in the market for a particular asset, forcing owners to sell it for less than its actual value. With liquidity, a lot of people simply say, how easy can it be converted into cash? But it's how easy can it be converted into cash and at what price? Because you may have paid $1 million for a home, and you may find a buyer within a week or so, but you may have to sell it. In order to convert it into cash quickly, you now have to sell it for a lower price. Another thing, liquidity risk, there are certificates of deposits. There is actually a liquidity risk attached to your certificate of deposit, because if you decide to break it early, you can break it early. But if you decide to break it early, you don't have to pay a charge, but you receive a less than expected return. So if it is you got tied into a fixed deposit for 1.25% per annum and you break it early, you would only receive 0.5%, which is a quoted rate on the savings account. You get the quoted rate on the regular savings account if you break it early. So you may not have had to pay a fee, but you receive a less than expected return, which means there was a cost attached to you. So that is what liquidity risk really refers to. The next risk is market risk. The risk that because general market pressures will cause the value of an investment to fluctuate, it may be necessary to liquidate a position during a down period in the cycle. Market risk is highest for securities with above average price volatility and lowest for stable securities such as treasury bills. Market risk is of little consequences to a person who purchases securities with the intention of holding them for long periods. So basically, market risk is attached mostly to equities. Basically, it's the equities because, and especially if it is you're trading equities frequently and you're not holding it for a long period, it will have a greater exposure to market risk, where is the powers of demand and supply and general other economic pressures that will affect the prices. Credit risk. It's easy to understand credit risk. If you think about when it is you go into a bank to apply for a loan, the first thing the bank does is assess your credit worthiness. They look at your credit rating. They will see how likely it is for you to default on your payment, or if it is you're likely to have a good credit rating and actually make your payments. You need to think of it in the same way for investments such as bonds. When investing into a bond, you need to look at the credit worthiness of the issuer of the bond. There are different ratings for different corporations, government agencies as well, for when it is they are issuing bonds. So a bond issued by the government of Trinidad and Tobago will have a very different credit rating from a bond issued by the government of, say, Nigeria. Trinidad and Tobago currently enjoys a fairly good rating. The government of the United States enjoys a very high rating. So when it is you hear a bond, they can afford to issue a bond at a very low rate, whereas a bond being issued by a country with a very poor rating will have to issue it with a very high rate in order to attract investors. So this is what credit risk refers to. Interest rate risk. A lot of people in Trinidad and Tobago actually think that interest rate risk refers to the chances that the interest rate on a return or on an investment will change, because they seem to think, is it that the 2.5% is guaranteed? Will it change next month? That is not interest rate risk. Interest rate risk is a possibility of a reduction in the value of a security, especially a bond, resulting from the rise in interest rates. This risk can be reduced by diversifying the durations of the fixed income investments that are held at a given time. There is an inverse relationship between the price of bonds and interest rates in the economy. When interest rates in the economy are very low, the price of bonds will be very high for the very reason that if your bank is offering you 1.25% on a certificate of deposit for your $1 million, whereas you can find a bond on the secondary market that has 5 years left to maturity and it has a quoted interest rate of 6 or 7%, you will now be willing to pay more than the $1 million par value on that bond. You might now be willing to pay $1,050,000. just to get the higher rate. So then the demand for bonds increase. And when the demand for bonds increase, the price of the bonds will increase. So there's an inverse relationship with interest rates in the economy and the price of bonds. Not the quoted coupon rates on the bonds, that remains the same, but the price of bonds, the market value of the bonds is what is affected by changes in the interest rate risk. And that is why you would see that in the past 2 to 3 years in Trinidad and Tobago, when interest rates have been fairly low, the investments that have a larger portion in bonds have actually outperformed the other mutual funds. Principal risk. This is basically the risk that investment will decline in value below the amount that you invested. This applies to the investments and mutual funds that have a fluctuating unit price. If the unit price is fluctuating, it simply means that the price at which you subscribe and the price at which you redeem might be very different. So you may buy into a mutual fund when the unit price is $12, but what determines whether you make a profit or a loss is the unit price on the day that you redeem. Because while you held it, it may have gone from $12 to $13. But if when you come to redeem it, it's 11.59, it means that you've actually made a loss because it's fell under the price that you purchased that. So principal risk is whether or not there is a safety of the principal that you invested, and this applies to the mutual funds and investments that have a fluctuating unit price. Our first poll for today, guys. Would you be interested in becoming part of an online community receiving updates on returns on mutual funds, savings, and investment tips, etc. via email or other online media? Please send yes or no. Again, would you be interested in becoming part of an online community receiving updates on returns on mutual funds, savings, and investment tips, etc. via email or other online media? And now we continue. Financial planning by life stages. The 4 basic stages of life are the foundation years, the accumulation years, preservation years, and the golden years. I'm going to give you some brief financial tips for the foundation, accumulation, and preservation years. Foundation years. Avoid credit card debt and consumer debt as much as possible. In your foundation years, you should be focusing on building your capital. Take advantage of compounding interest. The younger you are, the more your money can work for you in investments. What I'd like to point out is that we did not attach ages to these stages. We did not attach ages to the foundation, accumulation, or preservation years. Rather, we tell you at what point in your life, because what we found is that there are many persons who, right out of secondary school, into college, into the working field, whereas there's someone who might take 5 to 10 years, travel the world, find themselves, and when they're 20 or 29, then decide, okay, now it's time for me to go to college, get my degree, and get my life started. So we didn't attach ages. We rather just left it on what it is you're doing at this point in your life. So again, avoid credit card debt and consumer debt as much as possible. Take advantage of compounding interest. We spoke about that. The younger you are, the more your money can work for you in your investments. And really and truly, when you're younger, you need to start the deferred annuity plans because you can make so much towards your retirement by enjoying compounding interest. You need to manage your cash flow. If you get into that habit, as soon as you start earning income, you start doing proper budgeting. And for those of you who are interested in getting proper budgeting tips, you can always shoot me an email. You'll get the email address at the end of the presentation. And we will be happy to help you in planning and proper budgeting planning. So this can help you. If you get into that habit from the time you start earning your salary, you'll find that everything else falls into place. Establish an emergency fund of 3 to 6 months living expenses. You need to seek insurance at this stage in your life. You do not wait until you find out that you may have an illness or you do get into an accident and realize that you did not have enough coverage. Before you actually, when you're young, chances are the alcohol and the cigarettes haven't damaged your body enough yet. This is the point where you can go do a medical and get insurance at a cheaper premium. So when you're younger, we normally advise that you see about your life insurance, your medical insurance at this stage. At each stage in life, you will always need to revisit your insurance policies, because during life, you would find that things change. You suddenly have dependents. You suddenly realize you're more susceptible to certain diseases. So at each stage, you need to revisit insurance. And this is not only life insurance, but also disability and health insurance. Lower premiums from a younger age, dependent on your health. As I said, when you're younger, chances are all the vices haven't begun to affect your body too badly just yet. Accumulation years. You need to expand your investment horizon to include stocks, bonds, and mutual funds that facilitate these investments. We spoke about inflation, and I can never stress enough how much that is your biggest enemy. In any savings and investment plan, inflation is going to be your biggest enemy, as well as taxes. But right now, we are fortunate that we don't have withholding taxes on our investments in Trinidad and Tobago, providing you are a resident of Trinidad and Tobago. Two biggest enemies will always be taxes and inflation, because this is what you use to calculate your real return. So you now need to expand your horizon to include stock, bonds, and mutual funds, so that when you take inflation and so on into consideration, you still have a positive return. Establish saving plans for education of children. I always tell my customers, if you started from when the child is as young as 1 or 2 years, you can put $50 a month, $100 a month, and you'll be amazed with how much you can accumulate by the time the child is ready to graduate from secondary school. You don't want to wait until your kid is 16, realize she has potential, and then start a savings plan. You need to do it from when they are young. Make extra payments towards your mortgage. When you are applying for a mortgage, find out if lump sum payments are allowed, what is the maximum or minimum that is allowed, how frequent it is. You can even find out if it is you can do the bi-weekly, where you make payments every 2 weeks, which means that there will be 26 payments in a year, which means that there will be 2 months where you are required to make 3 payments as opposed to 2. And you'll be amazed at how much you can save by taking a plan like that, because by having that 2 extra payments every year, you can reduce your mortgage by a few years and reduce your interest. The interest on a mortgage is ridiculous. Sometimes you're purchasing a home for $1 million and you take a 20-year mortgage, and when you check how much it is you paid back, it might be $1.8 million. Whereas if it is you took advantage of these, making extra payments, taking the bi-weekly payments and so on, you might have reduced your 20-year mortgage to 16 years and shaved off your interest payments by $200,000 easy. So you always need to find out what options are available to you. And again, as I said, you must review all insurance policies at each stage in life. Preservation years. You need to revisit your medical plans to ensure coverage for long-term illness and care. As we get older, there are 2 things that are inevitable in life: death and illness. There is no one person who might live to retirement at 60 and so on and say that they've never been sick in their life and never been to the doctor in their life. In fact, as you get older, you start to realize that you're on a first-name basis with your doctor, because you went from seeing him once a year to 3-4 times a year. And this is costly, and especially when you think about retirement, when it is your income is reduced, because you are no longer going to be getting your full salary. If you have a pension plan, you may get the maximum of 66%, 2/3, but you will now have greater medical expenses, and some medical coverages do not extend into retirement, so you're no longer covered with the company. So you need to revisit your own medical plans to ensure coverage for long-term illness and care. You need to review the payment options at retirement, the plans that you have, what payout plans they offer, what tax-free lump sums they offer. Sometimes I always advise you take the tax-free lump sum. It will mean a reduced pension from your deferred annuities, but that tax-free lump sum can actually be invested to make up for that reduced pension, plus you still have access to the capital, because in the event if you put the entire amount towards a pension plan and you have an emergency, you can't go to the insurance company and say, well, I'd like to get 1 year's pension in advance because I have an emergency. Whereas if you took the tax-free lump sum and invested it, you have that amount that you can touch in case of an emergency. At this age, this is the 3 to 5 years before retirement, you need to look at moving your investments to lower risk instruments. You don't want to find out that the $1.5 million that you save towards retirement is only worth $1 million when you actually retire. So you need to move it over to the lower risk investments, such as the money market, treasury bills, fixed income funds, and also you want to start paying off your debts. You do not want to go into retirement still having debts, especially credit card debt, because as I said, you're going to have a reduced income if you're living just off your company's pension and you didn't have any other plans in place. So with a reduced income and increased medical expenses and so on, you don't want to have debts as well. Factors to consider before getting into debt. Personal balance sheet. When you are thinking of applying for any credit facility, you need to look at how it's going to affect your personal balance sheet. It's very simple. All you need to do, list your assets on one side, list your liabilities on one side. When it is you're taking a loan, if you're purchasing a car, you will have a double entry. You'll have the car loan on your liability side, you have the value of the car on your asset side, but you need to remember that the moment you drive the car out of the showroom, the value decreases. So you would try to get your liability to come down. So you may not want to take a loan for 100% the value of the car plus the insurance, because then your liability will be greater than your asset when you enter it. Another loan I want to put is that when you take a loan for a vacation, you have a liability, but you have nothing to put on your asset side. Yes, you had fun, great stories to tell when you're back, memories, but nothing to put on the asset side of your balance sheet. And you don't want to put yourself where you end up in a negative net worth. So when you are considering getting into debt, you need to look at how it's going to affect your personal balance sheet. You also need to look at your debt service ratio. If you do not have a mortgage, we normally advise that you try to keep your debt service ratio under 30%. If it is you have a mortgage, we normally advise 35 to 40%, because you need to ensure that you still have, and it ties into the third point, you need to ensure that you still have funds to meet your other living expenses. Your salary should not be dedicated only to loan payments. You have other monthly expenses that need to be met. You need to ensure that you have the ability to service your monthly payments. So if it is your living expenses are already more than 60% than your salary, even if your debt service ratio says that you can qualify for the loan, if it is you don't have the means to pay it, do not apply for the loan. You also need to look at rates and fees. You need to shop around when quick tips to maintain a strong credit rating: make your loan payments on time. Make your utility payments on time, because these also show up when they're doing the automated credit bureau check. Keep your total debt under control and keep your debt service ratio as low as possible. You need to keep some facilities open, because someone with a positive credit rating will always be viewed better to a banker than someone with no credit rating. Someone with no credit rating, we have no way of assessing whether this person will be paying on time, or no way of assessing if they'll default on the payment. Whereas someone who had open facilities and has a positive credit rating, we will be able to give them faster approval, because we know chances are they will continue with this pattern. Do not frequently shop for new credit facilities. You do not want it to seem to a bank or a financial institution that you are always seeking credit facilities to get out of debt from other credit problems. Small tips to avoid debt problems. Insurance can remove some of the needs for loans. Medical insurance can remove the need for ever taking loans for medical procedures. Life insurance can remove the need for your dependents to have to take a loan in the event of the untimely death of the breadwinner in the family. So insurance can remove some of the needs for loans. Establishing and maintaining an emergency fund can also remove the need for some of these facilities. If it is you have an emergency fund, when it is you have extensive repairs to do on your home and so on, you may be, well, I wouldn't even call that an emergency. If it is something happens to your vehicle and it's costing you $4,000 to repair and the insurance isn't going to cover it, you can tap into your emergency fund as opposed to taking a small loan for that and simply bill back your emergency fund after. Try to maintain one loan. When you are seeking a new facility, consider consolidating your current facilities with a new facility in order to maintain one. So if it is you already have one loan and you're thinking of taking a new loan for $20,000, simply take a loan for that $20,000 plus the balance of your old loan, so you then have just one loan. Because we spoke about when it is you have more than one loan, that your many loan payments normally add up to more than what one loan payment would have been. Apply additional payments to your loans where possible. The key is to always pay off your debts on time or before time to avoid late charges and to avoid paying as much interest. If you pay off loans early, most institutions give you a rebate on the interest. And the second and final poll for today. Are you pleased with the direction that First Citizens Asset Management Limited is taking to bring financial literacy programs to the public? Please send yes or no. Again, are you pleased with the direction that First Citizens Asset Management Limited is taking to bring financial literacy programs to the public? Please send yes or no. And moving on, understanding your investments, which really was the last topic, if I recall correctly. Fixed income funds. We're basically going to touch on fixed income funds, income and growth funds, and a deferred annuity product, which are the three types of investments offered at First Citizens Asset Management Limited. Fixed income funds invest solely in fixed income instruments, namely bonds and certificates of deposits. Fixed income instruments do not mean that the amount paid will be fixed, but rather the frequency of the payments are fixed. So it doesn't mean that the interest rate stipulated or the rate of return stipulated on a fund is fixed, but rather the frequency. So it might be monthly fixed, quarterly fixed, semi-annually fixed. Bonds are semi-annual, certificates of deposits. You have the choice of monthly, quarterly, semi-annually, annually. It means the frequency of the payments can be fixed. Fixed income funds can actually be both long-term as well as short-term. For example, we have the Abercrombie Fixed Income Fund, which is short-term, and we have the Eltacooch Fixed Income Fund, which is long-term. Basically, the difference between this is the asset allocation. We said fixed income funds invest solely in fixed income instruments, namely bonds and certificates of deposits, as well as treasury bills. The Abercrombie will have a smaller bond portfolio, a larger certificate of deposit portfolio, a larger treasury bill portfolio, and some other cash equivalents, whereas the Eltacooch fund, which is medium to long term, will have a larger bond portfolio and a smaller certificate of deposits portfolio and a smaller treasury bill portfolio and cash equivalents. So it's the asset allocation that makes it different, because both are fixed income funds. Fixed income funds can pay either interest or dividends, but the payments are set periodically, not by rate of return. Fixed income funds do not include equity investments. So when you hear it's a fixed income fund, you know that it does not include equity investment. So although a fixed income fund may have a fluctuating unit price, it does not mean that it has any exposure to the equity market. Income and growth funds have a dual strategy. Basically, the name says it all. Income and growth. So it allows for capital appreciation, growth, and current income generation through dividends or interest payments. An income and growth fund may invest only in equities or a combination of stocks, bonds, and other securities. These funds usually cater to the balanced investor with a moderate risk appetite. These funds typically outperform income funds, but at most times yield lower returns than pure growth funds. So whereas we have the Abercrombie, which is an fixed income fund, and so on, the Immortal Income and Growth will most likely outperform in the medium to long term, because it gives you both exposure to the equity market as well as the bond market. A deferred annuity is a tool popularly used for retirement planning, and it works in two phases. There's a savings phase where contributions are made and capital accumulated, and an income phase where the plan is converted to an annuity and payments are received. Deferred annuities allow for capital accumulation without the earnings being taxed. In Trinidad and Tobago, funds are taxed only if the account is closed prior to maturity. Only if it's closed prior to maturity. If it's a registered deferred annuity, then you are required to pay 25% to the Board of Inland Revenue, because while you held this account, you were entitled to 25% deduction in your PAYE. Locally, there are no allowances for withdrawals from approved deferred annuities prior to maturity. Contributions to approved deferred annuities are tax deductible up to $30,000 per annum. This $30,000 is inclusive of all contributions to approved pension plans, approved deferred annuities, as well as 70% of your NIS contributions. You have two options at maturity with approved deferred annuity plans. At least 75% of the contributions must go towards the purchase of an annuity, that is your pension plan, and you may take 25% of your contributions plus part or all of your interest earned as a tax-free cash lump sum. The second option is that 100% of your contributions and 100% of your interest earned goes towards the purchase of your pension plan. Deferred annuities offered by commercial banks are defined contribution plans, meaning that there is no way for us to predict to you what the benefit will be at retirement. It all depends on the contributions that you make as well as the performance of the underlying investments in the investment scheme. And that brings us to the end of the presentation part, which I know went well over the 25 minutes, but it was a lot because it was an overview of all the topics that we covered in previous sessions. Any questions that you may have, you can send to investments@firstcitizenstt.com. That is the email to my entire department, and you will get a response within 24 to 48 hours. I am also going to see if any questions were submitted at this time. I am seeing, is there a penalty for reducing? One moment. It's a little bit small here. Excuse, is there a penalty for reducing the duration of a mortgage? If it is, you wish to close off your mortgage earlier, there's normally a period that you have to inform the institution. They may ask for a 2-month period, a 6-month period. It depends on the institution. However, I was saying if it is you took a bi-weekly mortgage as opposed to the fortnightly is twice per month. If you took the bi-weekly, you'll find that you end up making 2 extra payments a year, which actually reduces the time because of the 2 extra payments per year. So there's no charge for that. It actually works out better for you when you compare it to the fortnightly mortgage. Will Asset Management be doing any other webinars or seminars? We will not be doing any more webinars for this year. However, we will be doing seminars. We'll be doing one in South Trinidad as well as North Trinidad in November. We will send emails to our clients informing them of the date, time, and venue, and those will actually be probably 2 hours to 3 hours in length because it will be a lot more detailed than the webinars. How many investment opportunities are there in First Citizens Bank? In First Citizens for Investments, we actually have the asset management company, which has the mutual funds, which has the Abercrombie, Paria, Elsecoach, Immortal, as well as the deferred annuity plans. Plus we have First Citizens Investment Services, formerly known as CMMB, who offers other investment products. They have their fixed income paper, which yields higher returns and certificates of deposits. They also offer brokerage services. So you can check their site as well, which is on the First Citizens site. How can I listen to previous webinars? Within the next week, all the webinars will be placed online. Emails will be sent to everyone who registered for the webinars with the link to where it will be. What account would I recommend for an emergency savings? For the emergency savings, I normally advise that you use an account where you have easy access to the funds. So I would normally say the Abercrombie mutual fund or a regular savings account or a combination of both, because if the emergency occurs on the weekend, you don't have access to your Abercrombie fund, but you will have access to a regular savings account. So you need to have something that gives you easy access in the event of the emergency. For all other questions, you will get a response via email. And I'm seeing one about the deferred annuity. I will send you an email telling you what is the difference between what is offered by the commercial banks and the insurance companies. But we have run out of time. I thank you all for being with me. I especially thank those who have been with me from the first webinar to the 6th webinar. I will let all of you know when they are available online. Any questions, as I said, you can send it to investments@firstcitizenstt. What I would also like to mention is that our retail arm of the bank will be launching their first webinar tomorrow, Thursday, 6th October, 1 p.m. sharp. They'll be launching the More the Merrier loan campaign So for those of you interested in getting information in what the lower rates, faster approval, special prizes to be won and so on with the First Citizens annual Christmas, as we know it as a Christmas loan campaign, you can actually go to our website www.firstcitizenstt.com, register for tomorrow's webinar and get further information on that. I thank you all again, and I do wish you have a wonderful afternoon. And this is the end of the 6-step financial freedom webinar. Have a very good afternoon. Thank you very much. Goodbye.